welcome to another tutorial on adjusting entries. This is again a very common tested topic in accounting exams, and in this short tutorial we are going to look at when and how adjusting entries are made. I repeat again, this is quite an important topic and favorite topic for examiners in accounting exams. So the two most common scenarios where adjusting journal entries would be needed are when nothing has been recorded or entered into accounting books for certain expenses and revenues. But those expenses or revenues did occur and must be included in the current period's income statement and balance sheet. So basically it's saying that there was a journal entry, there was a financial transaction that happened, but it has not been recorded in the company's books. Another scenario would be something has already been entered in the accounting records, but the amount needs to be divided up between two or more accounting periods. So in the second scenario, basically, it is an adjustment to already recorded journal entry. So you have already recorded a journal entry, but you need to make an adjustment to that previous recorded journal entry. So the first example that we are going to look on adjusting entries is regarding prepaid expense. I have already made another video on what prepaid expenses are. They are nothing but basically when company has paid for their expenses in advance, that is a prepaid expense. You can watch my video on what prepaid expenses are. So let's look into the example. Company X has a year end on 31st December. On 1st Jan 2008, company paid $1,000 for rent expense for 24 months. So basically, so usually financial period is for 12 months, and the company has paid rent for 2 years. So this is for 2 years. The company has paid rent for 2 years on 1st January 2008. Prepare necessary journal entry on 1st Jan 2008 and an adjusting entry on 31st December 2008. So we would have two entries, one on 1st Jan 2008 and then an adjusting entry to the 1st Jan 2008 entry on 31st December 2008. So let's look into what would be our journal entry on 1st Jan 2008. I would like to remind you here that prepaid expenses are our current assets because the company has paid for their expense in advance, and the company would use the rental space in the upcoming years and months. So on 1st Jan 2008, the journal entry would be debit prepaid rent expense because that is our asset, and then credit cash because that's what we have paid. So $1,000, and remember debits are always going to be equal to credit. So debit prepaid rent expense and then credit cash $1,000 on 1st Jan 2008. Then on 31st December 2008, we would have an adjusting entry to our entry made on 1st Jan 2008. So on 31st December 2008, it would be an adjusting entry recording the rent expense for 1 year, which would be debit because expense is a debit nature account, so rent expense. Now, since we are at the end of the year, we have used the rent space for 1 year. We would have incurred the rent expense of $500 and then credit prepaid rent expense, prepaid rent expense for $500. So this is an adjusting entry to this. So this is the adjusting entry. So from $1,000, we have incurred the rent expense of $500 for the year ended 31st December 2008, and then our asset, this is the same account, prepaid rent expense and prepaid rent expense. So we would have to reduce our asset by $500. Moving on to our next example on accrued expense example. So if you remember, accrued expense is you have used the service, but you have not paid, but the company has not paid yet. So that is why this is our current liability. This is our current liability because the company has the obligation to pay. The company has the obligation to pay, Again, here I would like to remind that if you want to watch my video on accrued and prepaid items, you're always welcome to do so. Company X has a year end 31st December. On 31st December 2008, company incurred $400 of rent expense for the month of December. So this is basically telling me that for the month of December, the company X has incurred an expense of $400, and it was not paid until 1st Jan 2009. Company has already incurred the expense for the month of December for rent, which is $400, but the company has not paid yet until the company has not paid the rent until 1st Jan 2009. So what would be our journal entry on 31st December 2008, which is basically a type of adjusting entry. So this is a type of adjusting entry. This is, if you remember from the two scenarios, this is the first type of adjusting entry. So on 31st December 2008, we would have a debit and a credit, because these are two main components of our journal entry. So our credit would be rent payable $400, and our debit would be rent expense, because the expense has been incurred. So we would record the expense, rent expense debit $400. Debits are always going to be equal to credit. So this would be the entry to record the accrued expenses. Moving on to the example of prepaid revenue. Prepaid revenue is basically revenue received in advance. Revenue received in advance. This is also known as unearned revenue. Unearned revenue. So company X has a year end on 31st December. On 1st Jan 2008, company received $1,000 for a service to be performed over the course of 24 months, and the revenue is to be recorded in equal monthly installments. Prepare the necessary journal entry on 1st Jan 2008 and adjusting entry on 31st December 2008. So again, we would have two entries, one on 1st Jan 2008 and then another one on 31st December 2008. So what would be our journal entry on 1st January 2008? Our entry on 1st Jan 2008 would be, so on 1st Jan, the company received $1,000, right? So debit cash $1,000. The company has not yet performed the services, therefore it is a liability, and we would have a liability unearned called, unearned revenue $1,000. After making the journal entry of 1st Jan 2008, on 31st December 2008, we would have an adjusting entry. So this would be an adjusting entry to this entry on 1st Jan 2008. On 31st December 2008, we would have, or the company X would have performed some services, and now they can record the revenue. So, and would have also reduced some liability. So unearned. So we would have debit unearned revenue, because when you want to reduce the liability, you debit. So debit unearned revenue by $500, and then credit sales revenue by $500. The reason why we did so is because the revenue has to be earned over the next 24 months in equal installments. So basically $500 would be earned in 2008, and then $500 would be earned in the next year, 2009. Now we are going to look at our last example on accrued revenue. So accrued revenue is basically revenue that has been earned. So the company has the right to receive the revenue. Company X has the right to receive revenue, but they have not received so far. So company X again has a year end of 31st December. On 31st December 2008, company earned interest revenue of $400 and was paid on 1st Feb 2009. So what it is, this transaction is basically telling me that at the end of 31st December 2008, company earned an interest revenue of $400, but this would not be paid until 1st February 2009. However, this $400 has to be recorded in the financial statement of 2008. So therefore, we would have an adjusting entry on 31st December 2008 recording this this transaction. So our debit would be interest receivable. Our debit would be interest receivable, and our credit would be interest revenue for $400. I hope you found this video useful, and if you like this video, please give it a thumbs up and subscribe to my channel for more videos. Thank you very much.